How's it going? I'm Andrew from InvestorsHub.com, and happy Monday to you. Very excited to have Paul Schatz on the show. He's been on the show before, and he's from Heritage Capital. We're going to be chatting about the FOMC meeting and the inflation and all the stuff that goes with the FOMC meeting. And we actually talked to him last Friday, but I figured that it was more appropriate to put the video out this week because, it is the actual week of the FOMC meeting, and people are going to be talking about it. So if you like the video, please be sure to like, comment, and subscribe. You can follow us on Twitter at ihub_vision. And after a quick disclaimer, we'll hear from Paul. There'll also be some disclosures at the end, and all that stuff will be down in the description. So yeah, let's hear from Paul. We produce videos and content to share the perspective of different investors. No video we produce is designed or intended to be direct investing advice, and the investing opinions of our guests are their own. The participants may hold positions in the investments discussed. Invest at your own risk. Do your due diligence. So we're supposed to hear from the FOMC next week. Do you think that there's going to be any big announcements during that meeting? I know that there have been talk and whispers about the fact that the tapering of asset purchases could start very, very soon.
We are finally going to have an exciting FOMC meeting. It's been a while. Really, it's been since the middle of last year. And now, yes, the long-awaited surprise to almost no one, Jay Powell and his minions are going to announce a full taper. What I think will happen is they'll announce it next week, and then they'll taper December through June of 2022. Will be done June of 2022. It's long-awaited. This should have started over a year ago. No one on earth could argue that the housing market needs support. Certainly the stock market doesn't need support. So $120 billion going away, while it does matter, it's not going to be the death knell for stocks, bonds, or anything else for that matter.
So phase one of the pullback is supposed to be the tapering of asset purchases, right? And then phase two is supposed to be an increase in the price of lending money. So which of those two things do you think investors should be most watchful of?
All of the above, none of the above. So here's how it works. The markets have fully priced in the short term, the taper. No one's going to be shocked. There's very little Powell could say about the taper that's going to matter to investors in the short term. However, in the long term, they're taking away the punch bowl, and that punch bowl of $120 billion a month is significant. So although no one will be surprised, and I don't think you'll have an immediate reaction super negatively in equities, that's more of an intermediate term story. And that's going to have a little bit of a negative impact on equities. I'll say this, we're going to go from having a 30-mile-an-hour tailwind to having no tailwind. So it's going to feel a little different. Then they're going to raise rates. And I would say that's an almost certainty. They're going to raise rates second half of 2022 once or twice. The raising of the rates will be more headline-ish, if you will, but I think over the intermediate term, the reduction to eliminating bond purchases will have more of an impact on stocks.
So I'm a relatively new investor, and I want to run this thought by you. So the reverse repo process is where banks give money to the Fed to hold temporarily because they don't want the cash, right? And we've had, in order to get those securities, in order to perform that action, they have to then buy bonds, right? Well, the purchasing of the bonds then deflates the interest rate on the bonds, artificial buying pressure, which then makes it so that bonds are less lucrative, stock market gets propped up, right? People are like, well, I don't want to put my money in bonds. I'd rather put it in equities or stocks. Well, so if they stop buying bonds, then the rates go up, then people flow into bonds because it's a better deal. But then also there's this, $1.5 trillion worth of cash that's just like waiting in the wings over there, like dry powder. And that's going to flow into something. Maybe it flows into bonds. Maybe it flows into the stock market. Maybe it flows into the the real estate space. I couldn't find the word. So do you think that sort of the money flowing in is going to compensate for the rise in bond yields? That's basically the long path that I've taken you to my question.
Well, there's a lot to unpack there. So let me start with a couple of comments. One is, I don't agree with the assumptions as being fact. When QE, whatever we're calling this last one, infinity, when QE infinity began, bond yields were 60 basis points or 0.6%. That was April of 2020. Yesterday, bond yields were 1.6%. So we've gone up a full percent or more than double in bond yields as this QE has happened. So you could argue, which I would, that the market last year took the Fed to QE, and then the market's taking the Fed away from QE. This is what happened last time with QE1, QE2, then the QE twist and what have you last decade. The markets anticipate something happening and they price it in, and then they move on to the next event. So I don't think the fact that the Fed's going to stop buying 40 billion of mortgage-backed securities and 80 billion of treasuries, I don't believe that's going to lead to higher rates. Now, I do think the 10-year is going up and it's going to be above 2% sometime in the first quarter of 2022. But I don't think it's because QE is ending. And frankly, it's going up because of growth in the economy and inflation. So you're asking kind of what's going to happen to this money that's been QE'd, if you will. And essentially that is so the bonds have been added to bank balance sheets and there's been reverse repos. Like everything else, money flows where it's treated best. So when currencies rise or fall, that's the big picture. But here, money's going to flow where it's treated best. If the market gets ahead, finally catches up with and gets ahead of inflation, money's going to flow to short-term and intermediate-term bonds. That's just how it goes. And I'll warn viewers and listeners and investors, in the fourth quarter of 2018, when the repo problem first crept into the markets and we were seeing overnights at over $100 billion, the Fed was raising interest rates at that time. Now, with the reverse repo market, I think it hit $1 trillion, maybe once or twice, or maybe more. And that's with the Fed leaving rates at zero and adding pressure on top of rates. So I warn people to be super careful trying to connect the dots and doing an if-then statement. I don't think it works. It really depends on a lot of factors, and there's not a hard, fast rule for people to follow. But clearly one thing is true, and that is with the amount in the repo market, the overnight market between banks and the Fed, something wasn't right at the end of 2018 and 19. Certainly something hasn't been right now. There's something else at play, which is above my pay grade. And we're only going to find out after the Fed gets out of this business and see how the system handles everything.
That's always the challenge with the stock market, is that there's a million different moving parts all interacting with one another in different sizes and different shapes, what's been priced in, what's not been priced in. And so it's just an endless myriad of questions and interacting pieces. And that's what makes it exciting.
And you know what else? In so many markets, people assign this perfect correlation. If the dollar goes up, stocks have to go down. Well, yes, that's true sometimes. But in the 80s, the dollar soared. And what happened? Stocks went up. More recently, when the dollar soars, it's been a bit of a headwind. It's like when the dollar goes up, which it has been the last few months, oil has to go down because oil is priced in dollars. But look at the price of crude oil. It's soared. People who make those hard, fast assumptions in investing usually end up blowing up a portfolio. And frankly, it's usually the quants who assign the probability of blow up at some infinitesimally small number, and then it happens, and then they blow up, and then they need a rescue by the Fed or the banks or whomever. But yeah, it's fascinating. each regime of the market gives you different pieces behaving together and inversely.
So where do you think the market is heading in the intermediate term here?
I think there was a big pivot in the market in September. The September pullback, or the big big bad bear market, easy for me to say, the big bad bear market, which lopped all of 5.5% off the S&P 500, pivoted. And although technology is certainly not dead, today as we speak, Amazon and Apple certainly had huge earnings strikeouts. But I believe the market's going much higher into the first quarter. I think the rising tide is once again going to lift most ships higher, and it's going to be a broad-based, fun, FUN rally, because you're going to see whatever you want to call it, the reopening, reflation, inflation trade, where you see, banks, financials, materials, industrials, energy, along with some technology, rise significantly. And even the defensive sectors like, staples and utilities, I don't think they're going to collapse. They may just get dragged up for the ride, but that's not where the place investors should be. Investors should be in the more economically sensitive sectors. And that's what should lead the charge into 2022.
So inflation has been a big thing on everybody's mind for a while now. We've had, inflationary pressures from government intervention, as well as inflationary pressures from supply chain issues. So what are your thoughts on the direction of inflation here in the U.S.?
I got on the inflation bandwagon, I think it was August of 2020, and I thought I was a little late then. Little did I know that all of a sudden the media and the pundits will be talking about the 1970s again. One, this is not 1970s style inflation. Pure and simple, it's not. We do not have an energy crisis, nor are we going to have an energy crisis. That's number one. Number two, everyone is talking about two things: inflation, supply chain issues. When it filters down to Time and Newsweek, and it's on the ABC, CBS, Fox, NBC News at 7 o'clock, 6 o'clock, whatever your time is, and the average person in the bar is now talking about that instead of cryptocurrencies, that tells me one thing: it's so clear and present that the end is in sight. I feel with high conviction that one, inflation is going to peak in the next 5 months. To me, this is not going to be a topic that we're going to spiral higher throughout 2022. Look, inflation's running 6% right now. I think between 5.5% and 6% is going to be the ceiling. And again, next 5 months, I think that peaks. The supply chain also, every earnings report that I read and I listen to a call, they're all quoting the same thing: supply chain. It reminds me, it was eerily similar to when the last time the dollar was super strong. Everyone was blaming their woes on a stronger dollar. Any problem they had, well, there's a stronger dollar giving us headwinds. I can't tell you how the supply chain is going to get fixed. Only that when it becomes ubiquitous, when every company is hiding behind it as a reason, that's the end of the theme. So like inflation, I think the supply chain, I would say with strong conviction, the supply chain woes are going to peak in the next 2 to 3 months. And it's going to slowly taper away. And we won't even be talking about it at the end of 2022. I mean, just look I was in Florida this week for work, and I see that they're figuring out how to bring some of these ships and containers into Florida to supply Florida companies. Well, if one state can do it, and granted, not every state has the coastline of Florida, other states can as well. So I think a lot of the bull market worries and economic worries are short-term and peaking. And that's why our main theme for the economy is that right now in November, which starts next week, and December and January, the economy is going to sharply reaccelerate higher. Q3 is going to be a trough, and the economy is going to really hum in end of this year and Q1 of 2022.
So do you have any final thoughts?
I don't think investors should be scared out. And this is happening way too much. I saw it in September, 5% decline. People are acting like it's 2008 again. Investors need to be careful not to get too scared of the headlines every day on TV. Negativity sells. The economy is going to reaccelerate. you should have a broad-based rally. Look for some stocks that people aren't talking about. Get away from the Apples and the Nvidias. Not that there's anything wrong with them, but they've had runs. We've been looking heavily at industrials, which we own. Trinity makes rail cars, Rockwell, the big defense and industrial contractor, and Ecolab. Three great industrial stocks that have been consolidating, doesn't garner a lot of attention on TV. And I think there is an opportunity for investors. And again, we own those already.
So do you have any disclosures or disclaimers you'd like to make?
Those are the three of the stocks you mentioned. That's it. And on the sector side, we do own industrials and we do own materials and energy and banks and financials. And weakness comes. I'm a buyer for a run into the new year.
Hey, thanks for watching, and be sure to like, comment, and subscribe if you hadn't already. And see you again soon.